Guys, welcome back to the channel. So today we are doing an account update again, but I'm on my computer this time and everything's looking really good. Man, it was a bullish morning. Amazon alone, I'm almost maxed out on these and this expires Friday. I bought 6 of these for average 80 cents a piece. They're now worth 6 cents. So if I can get out of this at 2 cents, I threw an order out there right here to buy these back at 2 cents a piece. So this would be $4.80 minus $12, so $468 profit I'll make if I could buy these back either today or tomorrow. And look, they're already at 2 cents. So I might end up getting filled on this live. Who knows? $468, that'd be my profit. So off these two contracts, off these two spreads alone this week, this one expires today. I'm gonna make the full amount. It's worth 0, so it's gonna expire. It needs to be above 370. Spies at 383. So there's no way that this thing is gonna not gonna print me money today. So $91 on this. If I could get $468 on this and get out of both of these today, I'll make $559 in 2 days. And I'm not even done trading. I'm gonna do another trade. Well, I'm at least gonna use, I'll have a, let's see, $1,300 collateral released once these expire today. So these are going to expire worthless, and I'm probably not going to get in another trade until tomorrow. After the market opens, I'll probably end up getting into another very conservative SPY trade. Like, let's take a look now. I mean, the prices are going to be different, but if I was to do a dollar spread, I could do another 13 contracts once this expires. So the whole point of this video was for me to go over what a spread is. What is a spread? So a spread is the buying and selling in the same time of 2 or more either calls or puts, or you can even get advanced. You can go up to, like, I don't even know. I know you can do 4 at a time on Robinhood, but on other brokerages, I think like Tastyworks and stuff like that, who are very specific with the options and spreads, you can do like 8-legged options, I think. So at least two options, a buy and a sell at the same time, creates a spread. I know someone was asking on my video, my last video, you know, how do you do a spread? What exactly is a spread? So I'm gonna go over that right now. So someone asked me, can you explain in layman's terms what exactly I'm doing? And what are the expiration dates and spreads? Alright, so let's go back to the main screen. So let's just say that this expired right now and it released my collateral of 13 contracts, a dollar spread, so $100 a piece times 13, so it's going to release $1,300 collateral into my buying power, plus the 91's already in here, I think. So let's just say I had $1,300 to work with. Go to SPY, trade options. Now my big thing I've been liking are put credit spreads. So you receive a credit, you're essentially selling, You're selling a spread to someone. They're buying the spread, so they're paying you. You're receiving the credit, and you want the price to stay above your higher strike price. Alright, so let's go to, this is today, January 22nd. So these are Friday. So the price of the SPY right now is 383. So the SPY, moves up and down on average like a couple dollars a day. So the one I'm in right now is at 369, 370, which is very high probability trade. It's way, way, way out of the money. So if you wanted to pick something like this, it's too far out of the money. So I'm going to take the strike price, or the share price right now, and I'm going to go down $9. So from 383 to 374. So 374. So a spread is where you buy a put or a call. So say I'm buying this for $25, right? So $25 is coming out of my pocket. Gone. $25 gone. Let's do this on the calculator. So I own $25. It's in my pocket. I want to buy this. It's going to cost me $25. So 25 minus 25. So now I have $0. So now if I take the 374, you can sell that for $30, right? So now I have $0. I want to sell this for $30. They're going to take, it's actually going to be one transaction now. So let's do this a little different. So actually, let's just say I sell, let's start over. All right. So how about we sell first? So the price we want SPY to stay above is the strike price we're going to sell. So I want the SPY to stay above, like I said, 374, right? So I'm going to sell this put. So this is going to cost $30. All right, I sold it. Someone paid me $30. So now in order to create a spread, you have to buy a cheaper strike. So that's going to be the one right underneath it. So you would buy this one. So now that's costing me $25 of my $30. So minus $25. So I'm left with $5. So to create this spread, I will get paid $5. Now, the brokerage wants to hold the difference between the strike prices, which is $1 times 100, because it's an option contract. So $100. So essentially, this trade right here is pretty conservative, right? You have 2 days for the SPY to go down about $9 to $10. They're going to hold $100, and I'm going to make $5 right off the bat. So say I had $1,000 to play with. I could buy 10 of these. So I could buy 10 of these. I would get paid $50, and they would hold $1,000. So right now, actually, it went up another, well, this went down 1 cent. So actually, I would make $60 off 1,000. It's the higher probability the trade is, the more collateral you're going to make, and well, the more collateral you're going to have to shell out, and the less return you're going to get off the back end. But this is the risk you're willing to take. This is a very low risk, low reward trade. So If it's low risk, it's going to be low reward. If it's high risk, it's going to be high reward. And this is a put credit spread. Remember, put credit spread is bearish. Put debit Wait, did I just say that? What did I say? Put credit spread is bullish because you want the price to stay above this. A put debit spread is a complete opposite. So say you still want to sell this call, then you'd buy the call above it. So let's do one contract. So now you're doing the complete opposite. So now you're selling something for $30. So now you have $30, but you're buying something for $37. So now that $30 goes to buy the $37, and then there's still $7 that needs to be accounted for. That's where this comes in, your max cost. So this is going to cost you $7. A put debit spread is bullish. Is bearish, I mean. So put credit is bullish, put debit is bearish. So on this one, you want the price to be below 374. This is a very high risk, high reward trade. You want the price to be below 374 by expiration. This would cost $7. But if you do win on this trade and say the SPY is 370, 350 at the end of January 22nd, then you're going to make $100 minus what you paid for this, $7. So this is a high risk, high reward trade. You're paying $7 to make $93. But look at the probability. I mean, it's very low odds that the SPY is going to be below 374 by Friday. It's a big move, and SPY normally doesn't move like that. So this is why I recommend for anyone who wants to create a spread up here, right, and doesn't know how it's going to play out. This is what you do. And I've done this in my previous videos. You go to this website, optionsprofitcalculator.com. optionsprofitcalculator.com. Very easy. Here's your two spreads, two basic spreads, credit spread and then your call spread or your put spread. This is selling. So you either want a credit spread or a call spread. Let's do a call spread or a put spread. It doesn't matter. You just do whatever. So this is a put spread. So let's put this in here. I got a put. I'm buying and selling a put. I'm buying the 375. I'm selling the 374. Let's put that in. I want this video to be kind of quick. So SPY. Buy and sell. Buying, writing, and selling. Buying January 22nd, the 375. Puts are on this side, calls are on the left side, puts are on the right side. Buying the 375 put, go to the mid price. Selling the 374 put, go to the mid price. Here you go, right here, net debit. A debit, it's either going to say net debit, which means you pay, or net credit. Hit calculate. Net credit means you're gonna get paid. So net debit $7, entry cost $7, maximum risk is your entry cost. Maximum return, like I said, is $93. There's your break even. It's your lower strike plus how much you paid. Here it is right here. Here's today, here's tomorrow, here's Friday. Expiration is probably like after hours closing. So you need the price to be below 374 for max profit, anywhere below 374. This is how you, when you're a beginner and you don't know what you're getting yourself into, and you're just clicking up here and you're like, all right, and you're like, all right, I'm going to put debit. Oh wait, now I'm in a $2 wide put credit. So you can straddle out these prices. You don't have to go right under. This is going to be a bigger credit because now you're widening out your strike. So now, but this is going to cost you more. Instead of $1, now you have a $2 wide spread. So it's going to cost you $200. So if you wanted 5 of these, it's going to be $1,000 collateral, and it's going to pay $40. But the likelihood of this happening is very probable. I don't know where you can go to check the probability percentage. Is it up here? Probability. It does not say the probability up here. But anyways, that's it. That's it. That's what a spread is. That's how you make a spread. Very simple. And like I said, if you're making a spread, and you're just going to like Tesla, you know, and you kind of have an idea, oh, I want to put credit for Friday for 800, and you don't know what to do. Remember, in the top right, it will always tell you what kind of spread you're in. So if you were to buy and sell, you'd be like, oh man, I want to put credit spread, but that's a debit, so I need to sell the strike above. That puts you in a put credit. This would cost $500 because it's a $5 wide spread, and it would make $48. So if you were to do 2 of these, $1,000 collateral, and then you would be credited right off. You'd be paid $98. So these can fail if this does drop below both your strike prices, below $7.95. You'll lose this whole $1,000 minus the $96 because you keep this regardless. And then one more thing. Say you're in the spread right now. See, I'm in the spread. You want these to go, the price of the spread to go down because you want them to expire worthless. So you get your collateral back and you keep the maximum profit. If you want to get out of this, you got to buy it back for the price that it's at, so 4 cents. That's why I have this order placed to buy all 6 of these back at 2 cents a piece, or $2. So for $12. I'm hoping to get filled today or tomorrow. If not, I'm just going to let this expire on Friday. But if I could have this 3,000 available, this collateral release, so I can get into another trade on tomorrow, just something very conservative, just to make a little extra, I'm going to do that. But I'm definitely going to do the SPY and do another trade tomorrow when this expires today. So that's it, guys. I'm about to be up probably 500 to 600 this week because this is all looking extremely good. I'm up almost $150 away from my strike price and $13 away from my strike price on this one. This still has 2 days left. Alright guys, well that's going to be it for today. I hope I explained the process of a spread well enough. If anyone has any other questions, just ask me in the comment section below and I'll try to respond as soon as I can. Alright guys, catch you in the next one.